Hi there everybody and welcome back to another stock analysis video. Today I would like to analyze the company Amazon, the juggernaut that really doesn't need any introduction. Everybody knows what this company does. However, to be fair, most people know Amazon mainly through their retail store. They mainly get majority of their revenue when it comes to their AWS. So we're going to take a look at their fundamentals and see if we can come up with a good price, seeing that their earnings are actually coming out on Thursday after close. So with that said, let's get started with this analysis. We are going to jump right into the calculator, guys, because unfortunately Amazon does not pay a dividend. Ticker symbol of AMZN, market cap of $1.4 trillion, trillion with a T. This is, I believe, the third trillion-dollar company that I have analyzed so far on my channel. PE, guys, of 42.65. So this is already telling me that at the current share price of $2,763, this is a little bit expensive, right? Just by a little bit. I normally like to buy anything with a PE under 20. Yeah, 42 is a little bit more than 20. Now, seeing that, again, they do not pay a dividend, this means that their 5-year average free cash flow is going straight into themselves, make acquisitions, pay down debt, and buy back shares. Now coming over to the fundamentals, starting with, of course, the net income as always. 5 years ago of $3 billion to 1 year ago of $33.4 billion. Guys, that is an increase of, look at this, 1,000%. It cannot get better than this. Not only is it a huge increase percentage wise, it has been increasing year over year within the past 5 years as well. This is exactly what you want to see when it comes to a net income of a company. Now looking at the free cash flow. Guys, this is the lifeblood of the company. Cash from operations less your capital expenditures. 5 years ago of $6.4 billion to 1 year ago of negative $14.7 billion. Yeah, this actually happened, and this is actually not a surprise because, well, I kind of knew that it already happened, which actually is kind of a reason why I'm actually fairly excited to analyze Amazon, because this might actually change the numbers up a little bit. Now, this is a decrease in the past 5 years of 330%. However, even though last year they did a negative $14.7 billion in free cash flow, they're still in the positive average 5-year free cash flow of around $11.3 billion. So, even though this is a huge outlier, right? I mean, this is pretty much just came out of nowhere. They're still up. Not only that, 5, 4, 3, and 2 years ago, steadily going up. Now, looking at what actually caused this, understand what free cash flow is. It is the cash from operations, which I have right here, minus or add their capital expenditures. You can see right here. So we can see when it comes to their cash from operations, which is by far the most important part because this is the cash that they get from their operations. I mean, it's in the name. It was 18 to 30 to 38 to 66 to 46. So it was increasing pretty much within the past 4 years, and then last year they went down to around $46.3 billion. However, let's take a look at, of course, their capital expenditures. 5 years ago of almost 12 billion, then 13, then 16.9, then 40, then 61. So they pretty much increased it within the past, what, last year, and then 2 years ago, and 3 years ago, from 3 years ago to 2 years ago, and then from 2 years ago to 1 year ago. They increased it a huge amount. So yes, this is what's causing the free cash flow to come down significantly. However, capital expenditure, guys, it is essentially what the company uses in order to reinvest in themselves. So I don't really see this as a bad thing. Yes, I understand that it's negative. However, they're putting it back into themselves, right? It's not like they didn't do, to be fair, hang on, no, before I even say that, they did do less cash from operations the previous year. However, they also increased their capital expenditures by a significant amount. So the way that I see it is they're reinvesting in themselves. Yeah, this is a negative number. To be fair, I think that they're going to be just fine. Now coming to the revenue, 5 years ago of $178 billion to 1 year ago of $470 billion. That is an increase of 164%. Wow, that is absolutely insane. Not only are they positive, and they have been positive every single year, they are consistently increasing their revenue, which is exactly what you want to see when it comes to a company's revenue. Looking at the total assets minus the total liabilities. By the way, guys, when it comes to this, normally I had my stock fundamentals over here saying total current assets and total current liabilities. Let's change this now to total assets minus total liabilities, right? Let's take this in the long term, since my whole analysis is basically investing for generational wealth. I personally think that instead of taking this at the current, let's take this on the total. And all you have to do, guys, is just find total assets and total liabilities on the balance sheet. It should be roughly in the same area as the total current assets. So yeah, nothing really just changes. Just make sure, if you want, right, if you want, you can put in the total assets instead of the total current assets. But nonetheless, let's actually take a look at this now. If they were to liquidate all of their assets, how much money would they have after paying their liabilities? Well, currently they would be at $138.2 billion in total assets minus total liabilities. And not only that, just like we have seen every single year, it has been an increase in their total assets, which is just beautiful to see. Average total assets around $280.2 billion. Average total liabilities is around $196.4 billion. Average assets minus the average liabilities, we get around almost $84 billion. Now coming over here to the shares outstanding, a metric that tells you whether or not the company is diluting you as the investor by issuing shares or giving you a bigger piece of the company by buying back shares. And this is actually fairly surprising. I was not expecting this. We have seen pretty much all beautiful metrics when it comes to Amazon, except for that 1 year of negative cash flow. And even with that 1 year, they still have positive average 5-year free cash flow, which is mind-boggling. However, when it comes to the shares outstanding, 5 years ago of 484 million shares to today of 509 million shares. On the 5-year, that is an increase of 5.17%. And from the previous year to the current year, we're looking at 2 years ago to 1 year ago, they increased it almost 1.1%. So as it stands, yes, they are diluting you. However, guys, it's really not a lot. The way that I see this is they honestly probably saw, yo, our stock price is very, very overvalued, right? I think they reached the high of like close to 3,000 at one point, if I am not mistaken. Let's do this real quick and let's see. Amazon, yes, actually the 52-week high is at $3,773. So they probably just issued shares thinking, you know what, our stock price is way overpriced, let's just issue shares, right? Let's just issue a bunch of shares instead of taking on debt. Might as well just do this, because if anything, we don't even pay out a dividend. It doesn't really matter, because if anything, we just buy them back in the future. And lastly, they got their cash equivalents, and currently, guys, they have around $36 billion in cash equivalents, with an average cash equivalents of almost $34 billion. Now time to make some assumptions, low, median, high, using 3 different factors: growth, projected share buyback, and required rate of return. For the growth, guys, I like to use Seeking Alpha's growth tab, seeing at the revenue growth year over year and the revenue growth forward, making a conservative assumption between those two numbers. For the projected share buyback, I'm going to be using the shares outstanding graph that we just saw. And for the required rate of return, I like to keep it flat, 10% to match the S&P 500 across the board. So for my lowest assumption, let's say a 16% growth within the next 4 years and a projected share buyback of -4. This means that they're going to continue to issue shares at 4% within the next 4 years. So doing this actually comes out to be a target share price of $1,124. For my median assumption, a growth of 18%, projected share buyback of -2%. This comes out to be $1,221, and from a high assumption, revenue growth of 20%, projected share buyback of 1%, this is $1,339.57. Now let's adjust for debt. The way we do this is we take the cash equivalents and we add the net debt. If they have more debt than cash, this number comes down. If they have more cash than debt, then this number comes up. So you can see it does come down a little bit from my lowest assumption to $1,110.59. For my median assumption, $1,207.66. And for my highest assumption, $1,325.34. Now, me personally, I like to add a margin of safety of 5, 10, and 15%, just because I don't want to overpay for something. The more you pay for something today, the less returns you're going to have in the future. This gives you a nice cushion. Now, adding this margin of safety for my lowest assumption, $944 to $1,055. For my median assumption, it is $1,026.51 to $1,147.27, and for my high assumption, $1,126.54 to $1,259. Guys, the current share price is $2,763. So as it stands, this needs to pretty much still fall in half. And a lot of you guys are saying that needs to fall by like $1,000+. That's crazy. Well, understand, PE of 42.65 actually, so almost 43. So yeah, this may sound ridiculous. However, understand just how overpriced Amazon is just based off of their earnings. And not only that, guys, I'm not saying that Amazon isn't going to grow amazingly. Whenever I buy a retail, this is how much I am scared of Amazon. I guess not scared, but this is how much I worry about Amazon. Every single retail store that I buy, I try to make sure that it is Amazon proof. That's why I love Home Depot and I love Lowe's, because those stores are Amazon proof. If people go to renovate their house or to buy paint or whatever, they have to physically go to the store. They can't just buy it online. It's physically impossible. They want to actually see the paint in front of them to make a judgment. You can't do that online. So I'm not saying Amazon isn't going to grow. I'm just saying that at the current share price, it is very overvalued, and I personally don't want to overpay for growth. Now, all these numbers are based off of my assumptions. I say this in every single video. All of these numbers change if you change these assumptions. For example, let's say that you do not believe that Amazon in 4 years will grow at 20%. Let's say you believe it's going to grow at 30%, right? And they're going to start buying back tremendous shares at like 5%. Keeping the required rate of return the same, well, this number now shoots up to $1,800. Actually, $1,881 and then $1,866 adjusting for debt. So again, it really is up to you what you want to actually see in this company, right? If you think this company is going to grow this amount, then you have to put in your own numbers. Luckily for all of you guys, I have this calculator available for free. Anybody could have it. I say it in every single video. I have this one, the book value one, and a dividend tracker. I have videos in how to use all of them. Just look up my calculator playlist. There's videos on how to use all of them, where to find all these numbers, and all that good stuff. So if you guys want, it's available for free. Just go in there, go to the link, make a copy, and you make your own assumptions. Because at the end of the day, every investment is the present value of all future cash flow. This is not financial advice. I'm just showing you guys the raw numbers that anybody could get and my assumptions as to where I would put this company. All I'm asking for in return, guys, for these 3 free things is just please help me grow my channel. I mean, to be fair, all of you guys have subscribed. Love it. All of you guys haven't subscribed, well, I will actually try to do something really cool on Friday. I don't think anybody will be around to watch it because it'll be during work hours, but nonetheless, you guys can watch it afterwards. And yeah, hopefully, if you guys like it, then I might consider doing more in the future, probably on different days. But nonetheless, I try to put out as much content as possible. I try to give out as much free stuff as possible. All I'm asking in return, guys, is like, subscribe, comment, and help me grow my channel. We'd love to get to 1,000 subscribers by the end of the year. All in all, guys, Amazon is, well, it's Amazon. Honestly, like, it's Amazon. There's really nothing else for me to say. I would love to buy this company. Yeah, I would love to buy this company. Not at this current share price, though. Not gonna happen. That's way too expensive. Maybe in the future, if the share price falls or if their fundamentals get better, then maybe I might consider buying it. But as it stands, no way I'm gonna be buying this company at $2,763. And if this thing keeps going up to like $3,000 or $4,000, no way I'm gonna buy it. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new sites of BitChute, Odyssey, and Rumble. All links in the description below. I have a Let's Play channel as well. The link is also in the description. I have not posted in a while, mainly because I want to prioritize this week's earnings, because there's a lot of good companies and this is my main channel. So hopefully this weekend I'll be able to record a lot more Sonic Unleashed. But nonetheless, if you guys want to see that, you guys can follow me there. With that said, peace out and be on the lookout for the next stock analysis video.